Tariffs are taxes on imported goods. They increase the cost of these goods for consumers and businesses. This can lead to inflation and reduced economic activity. Recession risk refers to the likelihood of an economic downturn. A recession is generally defined as 2 consecutive quarters of negative economic growth. The recent imposition of new tariffs by the Trump administration has significantly increased the risk of a global recession. J.P. Morgan, a leading financial institution, has raised its global recession probability forecast to 60%. This suggests a real possibility that the world economy could experience a significant downturn. The new tariffs are broad-based and substantial. They are likely to have a significant impact on both the United States and global economies. The following sections will delve deeper into the specifics of these tariffs, their economic consequences, and the potential responses from financial markets and policymakers. President Trump, on what he dubbed Liberation Day, imposed new tariffs on a wide range of imports. These include a 10% baseline tariff on all goods entering the United States from any country. Additionally, specific countries face even higher tariffs on their exports to the United States. These tariffs are not based on reciprocal agreements but rather on perceived trade imbalances. The average tariff increase is a staggering 22 percentage points. This surpasses even the levels seen during the infamous Smoot-Hawley Tariff Act of 1930, which exacerbated the Great Depression. Economists predict dire consequences for the United States economy. Deutsche Bank and Bank of America estimate that these tariffs could reduce United States economic growth by 1 to 1.5 percentage points in 2025. The impact on American households is also projected to be severe. Estimates suggest that tariffs will cost United States households an average of $700 billion. This equates to a 2.4% hit to GDP and represents the largest tax increase since 1968. The burden of these tariffs will fall disproportionately on consumers, who will face higher prices for a wide range of goods. Financial markets have reacted sharply to the imposition of new tariffs. United States equity markets experienced their worst day since the 2020 COVID-19 outbreak, with $3 trillion wiped off their value. The sell-off erased 12 months of gains, reflecting growing investor fear and uncertainty. Investors, seeking safety, are rushing to bonds. This has driven down bond yields and increased the likelihood of interest rate cuts by the Federal Reserve. Barclays, a prominent financial institution, predicts 2 25 basis point rate cuts in 2025. While Bank of America does not currently foresee rate cuts, it acknowledges that the economy could be pushed to the precipice of recession. In such a scenario, the bank suggests that rate cuts of over 200 basis points may be necessary. The Federal Reserve faces a delicate balancing act as it tries to support the economy without fueling inflation. The impact of tariffs will vary across industries. Energy is expected to be the hardest hit, followed by technology, which relies heavily on global supply chains. Financial services are also vulnerable due to recession fears. Within the consumer sector, cyclical industries like apparel face potentially disastrous consequences, while defensive industries like food and beverages are expected to be more resilient. The imposition of these tariffs has raised serious concerns about a potential trade war. The arbitrary nature of the tariffs and the lack of consultation with trading partners have increased tensions. Upcoming negotiations may offer a path to de-escalation, but the outcome remains uncertain. The interconnectedness of the global economy means that tariffs, even those imposed unilaterally, have far-reaching consequences. They increase recession risks, disrupt markets, and create uncertainty for businesses and consumers alike. Careful and well-considered economic policies are essential to mitigate these risks and ensure sustainable economic growth.